two lectures, you have seen that we are dealing with the treatment of goodwill, and we have done the problems in which the goodwill has been brought in by the partner and the goodwill has not been brought in by the partner. Now, in this video, I'll explain to you if goodwill is partially brought in by the new partner. Now, let us read the question. A, B and C has a PSR in as 2:2:1. They take D and the new profit sharing ratio becomes 3:3:2:2. D brings 60,000 as capital and only 50% of the goodwill. Goodwill of the firm is valued at 2 lakh. You can see very clearly over here the partner is only brought in half of the goodwill. In the second case, we have three partners M, N and O, and the partners have a profit sharing ratio of 4:3:3. P comes in as a new partner, taking 1/5 share from M and N and 1/10 from O. P brings 2 lakh, which includes 40% of his share of goodwill. The goodwill of the firm is 1 lakh. So in this case, we have to first calculate the new profit sharing ratio, because only then can we understand how much goodwill P has to bring in. Now let us take one case to understand how the treatment will be for goodwill partially brought in by the new partner. You can see very carefully that there is ABC as old partners and they have a profit sharing ratio of 2:2:1, and they take a new partner D and the new profit sharing ratio becomes 3:3:2:2. So we have the old profit sharing ratio and we have the new profit sharing ratio. The first thing which we will do will be calculating the sacrificing ratio and then go ahead with whatever the other information is given. You can see very carefully that D brings in 60,000 as capital and only 50% of the goodwill. Whatever goodwill was supposed to be brought in by D, only 50% of the goodwill has been brought in by D, and the goodwill of the firm is valued at 2 lakh. So first let us calculate the sacrificing ratio and then go ahead with the journal entries. So first we'll calculate the sacrificing ratio for A. You can see very carefully, as you know, sacrificing ratio is old ratio minus new ratio. So we'll do it for A now. What is A's old ratio? 2/5. What is A's new ratio? 3/10. So what is the LCM? 10. So over here, if you divide 10 and 5, you get a 2. So 4 minus 3 gives you 1/10. Now for B, see very carefully, the same calculation, 2/5 minus 3/10. Therefore, it will be 4 minus 3/10, that is 1/10. And that for C, you can see it is 1/5 minus 2/10, and we all know that it will be 2 minus 2, therefore 0/10. So we have got the sacrificing ratio between A and B only, because A and B are the two sacrificing partners and the sacrificing ratio is equal, 1:1. The next step we'll do is we'll calculate the goodwill which D is supposed to bring in. Now, if you see, the goodwill of the firm is valued at 2 lakh, and what will be D's share? So over here, D's share of goodwill equals 2 lakh into 2/10. I hope it's very clear. 3:3:2:2, that means 2/10. And if you see very carefully, the goodwill is 40,000. This 40,000 is the goodwill which D is supposed to bring in, but D can only bring in half of it. And if D can only bring in half of it, that means D brings in 20,000. Now this 20,000 will be divided equally, 1:1 ratio. That is 10,000 to the first partner and 10,000 to the second partner, and the remaining 20,000 which has not been brought in will also be divided in the same 1:1 ratio. That means 10,000 to first partner A and 10,000 to second partner B. So let us get started with the journal entries over here. Please see very carefully that D brings in 60,000 as capital and 20,000 as the premium of goodwill. The first journal entry which we'll do over here is bank account debit 80,000 to D's capital account 60,000 to premium for goodwill to premium for goodwill 20,000, because half of 40,000 has been brought in by the partner D. Now the next journal entry will be premium for goodwill account debit 20,000 to A's capital account to B's capital account. That is 10,000, 10,000Y, because the sacrificing ratio was 1:1. Now we have dealt with the premium of goodwill which has been brought in. Now we also know that half of the goodwill has not been brought in, 20,000 has not been brought in, and if you have watched my previous video, we have said that when the goodwill is not brought in by the new partner, his current account will be debited and the sacrificing partner's capital account will be credited. So over here, the journal entry will be D's current account debit to A's capital account to B's capital account. See very carefully what is the amount. 20,000 goodwill not brought in, 10,000 to A's capital, 10,000 to B's capital. So I hope you are very clear with the difference. This is the treatment for the goodwill brought in, and this is the treatment for the goodwill not brought in by the partner. You can see D's current account has been debited by 20,000, or the amount of goodwill which has not been brought in, because the goodwill which D was supposed to bring in was 40,000 and D has only brought in half of it, so 20,000. So for that we have done the first journal entry, because he has brought a capital of 60,000 also. Therefore we have done bank account 80,000 to D's capital, 60,000 to premium for goodwill 20,000. The next journal entry is for the transfer of the premium of goodwill to the sacrificing partner's capital account, which we have done. Premium for goodwill 20,000 to A's capital account and B's capital account, because these are the only two partners who are sacrificing and C is not sacrificing anything. And the last journal entry is for the treatment of goodwill not brought in by the new partner, and we have credited the sacrificing partners by the same amount in 1:1 ratio, that is 10,000, 10,000. Now let us take another case. In this case, we can see there are three partners, M, N and O, and a new partner P comes in. P brings along with him some amount of money, which includes 40% of his share of goodwill, which we'll do later. First, let us calculate the new profit sharing ratio and the sacrificing ratio. Why do we need to calculate the new profit sharing ratio? We need to calculate the new profit sharing ratio because then only we can understand how much goodwill was supposed to be brought in by the new partner. So let's get started. We can see over here M, N and O are partners with a profit sharing ratio of 4:3:3, and they take the new partner as P, and P takes 1/5 share each from M and N and 1/10 from O. So let us first calculate the new profit sharing ratio, and then we'll go ahead with the calculation of the sacrificing ratio. So you can see what was M's original share. M's original share was 4/10, and from that 1/5 share has been taken. So you can see the LCM of this will be 10. So 4 minus 2, that gives us 2/10. And then we have the next partner as N. You can see 3/10 minus 1/5, that gives us 3 minus 2, that is 1/10. And then we have the next partner O, whose original share was 3/10, and from that we are subtracting 1/10. So we are getting 3 minus 1/10, that is 2/10. So you can see over here the share between M, N, O and P is 2:1:2:5. How did I get it? It's very simple calculation. 1/5 plus 1/5 plus 1/10. And if you calculate the LCM of 5 and 10, it gets 10 over here. So 2 plus 2 plus 1, is your 5 by 10. Otherwise, you can also add this. 2 plus 1 plus 2 gives you 5, and the denominator is the 10. Therefore, P share will be 5 by 10. Now, it's very clearly understood that whatever the goodwill of the firm is, half of the goodwill has to be brought in by the new partner. But that we'll do later. Let's first calculate the sacrificing ratio. As you know, the formula for sacrificing ratio is obviously old ratio minus new ratio. And what is the old ratio? The old ratio between M, N and O is given to us as 4:3:3. And what is the new ratio we have just now calculated? M, N, O and P, we have got 2:1:2:5. So first we'll calculate it for M. So 4 by 10 minus 2 by 10, that gives you 4 minus 2, 2 by 10. That for N, you can see over here 3 by 10 minus 1 by 10, that gives you 3 minus 1 by 10, that is 2 by 10. And that for the next partner, that is O, you can see very carefully 3 by 10 minus 2 by 10, that gives you 3 minus 2 by 10, that is 1 by 10. Therefore, we can conclude the sacrificing ratio is 2:2:1. That means whatever goodwill has been brought in by the new partner will be distributed among the 3 sacrificing partners, all of them M and O, in the ratio of 2:2:1, and the share of goodwill which has not been brought in will be debited to O's current account, P's current account, and will be credited to the capital accounts of the sacrificing partner over here, M, N and O. Now let us move on to the next part of the sum. After calculating the new profit sharing ratio as 2:1:2:5 and the sacrificing ratio among M, N and O, the old partners, as 2:2:1, now we'll go ahead with the journal entries and understand it. Now you can see over the information which has been given is P brings in 2 lakh, which includes 40% of his share of goodwill. That means 2 lakh includes 40% of his share of goodwill. Now first and foremost, you can see very carefully the goodwill of the firm is 1 lakh. So if the goodwill of the firm is 1 lakh, what will be the goodwill of P? P's goodwill will be calculated as 1 lakh into 5 by 10. Why? Because the ratio is 2:1:2:5. Therefore, you can very clearly see 50,000 is supposed to be brought in by P. But is P bringing in 50,000? The answer is no. P is only bringing in 40%. So 20,000 has been brought in and 30,000 has not been brought in. Please understand it very, very carefully. 20,000 has been brought in, 30,000 has not been brought in. Now this 20,000 will obviously be divided in the ratio of 2:2:1. So if I divide 20,000 by 5, I get 4,000. Therefore, we have 8,000 for the first partner, 8,000 for the second partner, and 4,000 for the third partner. Similarly, here also we will divide 30,000 in the ratio of 2:2:1, and 30,000 if you divide it by 5, we get a 6,000. So therefore, we have 12,000 for M, 12,000 for N, and 6,000 for O. So this you have actually calculated the amount of goodwill brought in and the amount of goodwill not brought in. Now you can see P has brought in 2 lakh, which includes 20,000 of the goodwill. That means total amount of money brought in as capital is 1,80,000. Let us start with the journal entries. First journal entry we'll do it is bank account debit to P's capital count to premium for goodwill. So how much is it? See very carefully. The total amount is 2 lakh, which includes 20,000 for the premium for goodwill. So 20,000. So obviously the capital is 1,80,000. I hope this part is very clear. See very carefully, the goodwill of the firm was 1 lakh and 50,000 belonged to the new partner P. and out of which he has brought in 40%. Therefore, 20,000 has been brought in. That is the reason why the journal entry has been passed. Bank account debit 2 lakh to freeze capital account 1,80,000 to premium for goodwill 20,000. Now the second part of the entry will be to distribute this premium for goodwill among the three sacrificing partners who are M and an O, and the ratio of 2:2:1, which we have already done over here, 8,000, 8,000 and 4,000. So the second journal entry, premium for goodwill account debit to the sacrificing partners, M's capital account to N's capital account to O's capital account. See very carefully, 20,000, 8,000 to M, 8,000 to N and 4,000 to O, because the sacrificing ratio 2:2:1, which we had just now calculated. The last journal entry will be the new partner's current account, that is P's current account debit. How much has not been brought in? 30,000. Current account debit, 30,000 has not been brought in to M's capital account to N's capital account to O's capital account. See very carefully, 12,000, 12,000, 6,000, because the sacrificing ratio is 2:2:1. So we have done this entry for the treatment of goodwill brought in and not brought in. This is part 3. Remember, part A or part 1 we have done where the goodwill has been brought in by the new partner. Now in part 2 we had done goodwill not brought in by the new partner, and part 3 we have done goodwill partially brought in by the new partner. Okay, so we can see very carefully, 60% of the goodwill was not brought in, 40% of the goodwill was brought in, 60% has been transferred in current account of the new partner, and 40% has been treated as premium for goodwill. With this, we conclude with the treatment of goodwill, and now we will come up with the next part of the chapter where we will talk about the concept of accumulated profits and losses and how it is treated on admission of the new partner. Keep watching my channel, don't miss any of my lectures, and if you have not yet subscribed my channel, please subscribe it and press the bell icon so that you don't miss any of my lectures.